Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is November 14th, 2024. We're going to talk about PPI, CPI, inflation data, and the potential destruction of demand. So as we're looking at this, S&P 500 is pulling back after the Fed speak today. We have a net negative move. We've talked about this move and this breakout over the last couple of weeks, that there was no volume behind it. And the fact that there's no volume, this could be a blow off top. The Trump bump may be done. But part of the reason why the Trump bump may be done is we're excited about the Trump bump, as it means people are hopeful for the economy. But the other side of that coin is, if the new Trump administration is going to be aggressive in slashing bureaucracy, that would also mean a massive decrease in demand. The US government used to be about 15% of GDP, and it's been over 20% of GDP when we look at the total government spending. And so if we're going to cut back that government spending, that is an indication that we're going to have lower and lower demand. We've talked about this over the last couple of weeks as well, that basic materials as a representation of actual demand has been sliding, and we're bearish on basic materials, and I don't see a reason to not still be bearish on basic materials. But let's look a little more at the data that would go into. And we'll talk a little bit more about this tomorrow when we go through the live. But the main thing I want you to notice here is that final demand rises 0.2%, 0.3%, 0.1%. So we're talking about PPI, Producer Price Index, costs went up 0.2, 0.3, and 0.1 for services and goods. So as we're looking at that, we're looking at the net value of the total demand is 0.2, but services have gone up. Costs have gone up for labor, costs have gone up service-wise, and when we look at CPI, we have it 0.2. That may not seem like that much. 0.2% is not that high. You can say, okay, we could extrapolate that to 2.4% inflation-wise, but the problem is that's year over year. It's still a cumulative effect. We're still seeing rising prices. Real average hourly earnings, meaning employment here, is still climbing. So as we're looking at that, we're looking at all that information. Costs of services, costs of labor are still climbing. Even though we're still seeing inflation pushing higher, we've been cutting rates. Normally, I'd want to run the data through the ZQ, the Fed Funds Futures, to see what is really being priced in, including the cost of the trade, so that I can see where the money is moving. But we're just going to use the CME's Fed Watch tool for just a minute. December rates, you can see our current is at 4.5 to 4.75, and December we're pricing in a 72% probability of one rate cut. Now that's a lot less than it was yesterday, so we're kind of unwinding that a little bit with the Fed speak today, but it's still showing that we're cutting rates, cutting rates, cutting rates. Now if we look all the way out to March and looking at the current rate at 4.5%, we're pricing in about a 78% chance of two rate cuts by March, and a little bit of chance of a third in March as well. But we're still looking at cutting rates even into the beginning of next year. So if we continue to cut rates, like we said last week, if the Fed is cutting rates, cutting rates, cutting rates, while inflation is holding at its high, they are seeing something that they're concerned about. And I believe that concern is employment. Last month, we saw that we only created 12,000 jobs, and we've revised most of the jobs data lower. I believe that we already have negative jobs at this moment in time, and we're going to see that impacting the market, which again supports the idea that demand is going to decrease. If the government's going to spend less money, that's a big if, but if the government's going to spend less money and consumers are losing their jobs, and after we get through the holiday season, what purchases are we going to make? I don't know. And that tells me that I do believe that we're going to see a continuation of a slowdown in demand. And my favorite indicator for demand in manufacturing is copper. And copper prices tried to rally, hit its head on the previous resistance, and has fallen all the way back down to the previous support. So we're at the lowest demand level, or lowest price for copper going back to September. And it's not going to take much more to get us through August, which means I'd be on track to see the strongest support level taking us all the way back to the beginning of 2024. This is a decrease in forward-looking demand, and copper is definitely in the downturn, which is why I am looking at basic materials as a bearish play. Bearish play with the lower highs, lower lows, lower highs, lower lows again, has me looking for basic materials to continue down to 90, 90.27. If basic materials are falling, that means that prices will likely begin to fall as well. But PPI is still showing that prices are still on the rise. So where do we look? If we look at the market watch today, looking at how the market behaved with everything that has gone on and the Fed speak, the only sectors that are up are consumer staples, utilities, and energy. And that's because crude is up off of its lows. Dollar's still climbing, dollar's still strengthening, and until basic materials bottom out, until commodities bottom out, and until the euro is not cutting rates faster than the US, the dollar index is going to keep on climbing. Crude's just a bargain basement price at $68 a barrel. So as we're watching this, utility is defensive, consumer staples is a defensive area, and everything else was negative. In fact, some of the worst was that basic materials and real estate. If we look at the market watch, you can see a lot of red here. Google, Meta, Amazon, Tesla, and those are the ones that lifted consumer discretionary in this last month. If we look across the stage, we can see, oh, there's some green in consumer staples, there's some green in utilities. Apple certainly is green, Disney on earnings, but everything else is either muted green or red, or bright red for that matter. This is not a good sign for the day, especially when the Fed is talking about rate cuts and hopefully encouraging the market. They've got you covered, but maybe what it is saying, we're worried, and therefore we're providing the stimulus to the economy because we know how bad this is going to get. For me, that means I will be looking for bearishness in the home builders and in U.S. real estate ETFs like this. We've already made lower highs and lower lows through here. This is the lower high, and the continuation would be to get through this low and find the next major support level down near 93.75 or 92. So we could see a bearish move all the way down to 92, which is about a 4 to 5% move in a matter of 2 or 3 weeks. And IWR could do that pretty quickly. ITB is going to be something similar if we're looking at that weakness in those sectors. And you can see we tried to stage a rally today and we gave it all back. This is not very bullish to me, and I'm looking for this continuation lower in home builders as well. If I want to pick a specific home builder, I know that Toll Brothers is a little bit overpriced, and yet they need to sell inventory. So if we can sell inventory here, we're looking for 137.50 on the downside for Toll Brothers, and that would be a pretty easy target for me to see that drop of 10%. Now, where else can we look? If consumer discretionary rose because of Tesla, then consumer discretionary should be falling now that Tesla's pulling back. And my favorite substitute as a representation of consumer discretionary minus Tesla is Nike. Nike has already continued this downtrend, lower highs, lower lows, lower highs, lower lows, and we're right on the cusp today of rolling over, and I would say this is enough to take the next leg down. The question is, can I break through 75.22? If we can, which was previous support, gap, resistance, Nike should be able to go back and test 71. So I'm looking for about an 8% decline in Nike. Additionally, sticking with the brand names, I would be looking at Levi to break through its short-term support, which plays into a long-term support, meaning break through the last week's low, and it breaks through the long-term support. And I'd be looking at Levi Strauss coming back down to 14.89. Levi is a cheaper stock. It's going to be a little bit harder to be able to make that trade, but the percentage move going from 16 down to 14 is about a 12.5% move. Now, lest you think that I'm only bearish, which I kind of am, but there are some opportunities to buy things at a discount. And part of that comes from XLP Consumer Staples stabilizing here while everything else is pulling back. They're stabilizing and finding a bounce opportunity in this chart. And I'm looking at this indication as a confirmation that we could sell puts to get into something like XLP if we can get paid about 2 to 3% down here. Anything above 80 is an opportunity to potentially buy all the way back to 83, but that's just the ETF. To get away from the diversification into the specifics, and to tease you a little bit with tomorrow's discussion on dividend stocks, I'm liking Pepsi, potentially, Procter & Gamble, Philip Morris. Altria, I would like to be able to take a position there, but today is pretty flat. But I'm going to be looking over here in these consumer staple stocks for those opportunities. And Pepsi had a phenomenal day today, fell back to the area that it established support around earnings, gap down, closed up, and said, this is my key level. This is the support around 162. Today is the confirmation that yesterday was the bounce. We've followed through. We've cleared out the highs of the last week. Pepsi looks very promising. Not only is it a dividend-paying stock, but I'd be looking for a move back up to 176. And if we can go from 166 to 176 on something like Pepsi, we're going to make the $10 there. And even if it takes 3 months, 6 months, the dividend yield is an additional 3.25%. And so we could be looking at 11, 12% over the next 6 months when we adjust for the dividends. And again, I will talk about this more with Brandon tomorrow morning on TheoTrade Live, so I definitely would encourage you to join us tomorrow morning. Bright and early. Actually, it'll still be dark here, so dark and early as we discuss the week, CPI, PPI, dividend-paying stocks, opportunities to be able to hedge against the Trump bump, and what it means if we see lower government spending going forward into this new economy. So join me again tomorrow. Thanks for watching, and we'll see you in the morning.